In 2008, the U.S. government became the world's biggest insurance company overnight, without ever asking taxpayers. Not to protect your house, not your job, but to back $180 billion in risky bets made by traders in London on U.S. mortgages. You never bought a casino chip, but somehow, you're the one paying the bill. Welcome to the Wealth Timeline, where we uncover how money, power, and history collide to shape the world you live in. Today, we're exposing the biggest, most sophisticated gambling operation in human history. An operation where governments place trillion-dollar bets. And when those bets go wrong, you pay the losses. This story starts with a single moment that changed the entire global economy. August 15, 1971. President Richard Nixon goes on TV and announces the U.S. will no longer convert dollars into gold. Just like that, the Bretton Woods system created after World War II to stabilize global trade was gone. But instead of chaos, something else happened. Governments were suddenly free. For the first time, money didn't need gold behind it. It was backed only by trust and a government's promise. Central banks like the Federal Reserve, the European Central Bank, the Bank of Japan gained powers no one had seen before. They could print unlimited amounts of money, they could borrow against the future, they could influence markets directly. And by the 1980s, governments realized something bigger. They didn't just control the casino, they could play in it. The U.S. Treasury started using derivatives. Central banks started buying corporate debt and pushing stock markets upward. The line between referee and player began to disappear. Phase 1. The derivatives explosion 1980s, 1990s, and 1980. Derivatives were barely a blip. By 2000, their total value hit $95 trillion. By 2008, over $600 trillion, about 10 times global GDP. Governments didn't just regulate this market, they were inside it. Fannie Mae and Freddie Mac became the biggest creators of mortgage-backed securities in history. These weren't basic home loans. They were carved up, repackaged, insured, and sold worldwide. Then came 1998. Long-term capital management run by two Nobel Prize winners nearly blew up the global financial system. The Federal Reserve brokered a $3.6 billion private bailout, setting a new rule. If the bet is big enough, the government will step in. Phase 2. The central bank put 2000 to 2007 after the dot-com crash. The Federal Reserve, led by Alan Greenspan, lashed interest rates to 1% and flooded markets with cheap money. But more importantly, the Fed signaled, "We won't let markets fall too far." Investors called it the Greenspan Put, a safety net under the stock market. With that, risk exploded. Hedge funds borrowed more. Banks used extreme leverage, asset prices rose on artificial support by 2007. America's 5 biggest investment banks controlled $4 trillion in assets, but only $200 billion in actual capital. A 20-to-1 leverage ratio. One wrong bet could take down the whole system. Phase 3. Sovereign speculation. 2003 to 2008 governments became active traders. China's reserve managers traded currencies, commodities, and equities. Norway's sovereign wealth fund bought global stocks. The U.S. government backed trillions in mortgage debt through Fannie and Freddie. The casino went global. The players weren't just banks, they were entire nations. September 15, 2008, Lehman Brothers collapses. In 2 days, $500 billion disappears from money market funds. Credit markets freeze. Banks stop lending. The global system seizure begins. The cause: a worldwide chain reaction of leveraged bets on U.S. mortgages. But here's the buried truth. Governments weren't innocent spectators. They were in the game. When the crash hit, the U.S. took over Fannie Mae and Freddie Mac, assuming $5.4 trillion in liabilities. The Federal Reserve secretly issued $29 trillion in emergency loans. AIG received $180 billion because it had insured the bets of every major global bank in Europe. Sovereign debt crises erupted. Greece, Ireland, Spain, Portugal all facing insolvency after bailing out their own banks. The house wasn't winning. The house was burning down, and taxpayers became the fire department. Today, the casino is bigger than ever. Global debt, government plus corporate plus household, has reached $307 trillion 2024. That's 336% of global GDP. Central banks hold over $25 trillion in assets from massive bond buying programs. And the new bets are getting stranger. Negative interest rates. The European Central Bank and the Bank of Japan have charged banks to store money, flipping centuries of financial logic. Cryptocurrency reserves. El Salvador adopted Bitcoin as legal tender and holds it in national reserves. Climate-linked derivatives. Governments are now issuing financial products tied to carbon prices and climate targets. In the Federal Reserve's balance sheet, 2007, $870 billion. 2022 peak, $9 trillion. That's not normal policy. That's nation-sized speculation. The next stage? Central bank digital currencies, programmable dollars controlled directly by governments. The casino floor keeps expanding. So what does all this mean? 1. Money became abstract, which expanded government power. Once we left the gold standard, the limits on government vanished. 2. Moral hazard is real. Every bailout encourages more risk. The bill eventually shows up in taxes, in inflation, or in lost savings. 3. The casino never closes, simply shifts to a new game. Derivatives gives sovereign debt, gives digital currencies. And every time governments place a bet, you are the one covering the downside. In the timeline of wealth, every rise has a hidden cost, and someone always pays the dealer. If you enjoyed this breakdown, hit the like button, subscribe to the Wealth Timeline, and turn on the bell, because the next chapter in financial history is already unfolding.